This is not a drill. This is not a headline you scroll past. This is the kind of move that changes everything, and almost no one is ready for it. Because what the Federal Reserve just did is going to hit harder than anyone expects. And the most dangerous part? They're pretending it's no big deal. Let's get to the truth. This week, the Fed made what looks like a simple decision. They held interest rates steady. They didn't raise them. They didn't cut them. They just paused. But that pause wasn't neutral. It wasn't calming. It wasn't safe. It was a red flag wrapped in silence. Behind that quiet decision is a storm that's been building for months. Inflation has cooled, at least on paper. The most recent CPI shows year-over-year inflation sitting at 2.4% based on May's CPI. Core PCE has dropped close to target. Consumer spending has slowed. Job growth is starting to wobble. By all traditional metrics, this is the moment the Fed should be easing. But they're not. And that silence, that refusal to move, that's the most terrifying signal they've sent in years. Because when central banks stop acting on logic and start acting on fear, the entire system becomes unstable. So let's ask the real question. What are they so afraid of? The answer starts with credibility. If the Fed cuts rates now, after inflation finally cooled, they risk reigniting the fire. And if inflation returns, they lose everything. The markets stop listening. The dollar loses trust. Their power evaporates. So they've chosen the most dangerous path of all, doing nothing and hoping the system holds. But under the surface, it's already cracking. Here's what's actually happening right now. Mortgage rates are hovering just above 6.91%. New home applications have dropped 5 weeks in a row. Auto loan delinquencies are climbing. Credit card interest rates are at all-time highs. Small businesses are getting denied funding at the fastest rate since 2009. Meanwhile, the bond market is flashing a recession warning louder than ever. The 2-year yield is still higher than the 10-year, a yield curve inversion that has predicted every major recession in modern history. That signal has been active for over 200 days now, and the Fed is still pretending it's not time to act. Why? Because this isn't about data anymore. It's about optics, politics, control. Behind the scenes, political pressure is boiling over. President Trump has already slammed Fed Chair Jerome Powell, calling him a numbskull and demanding immediate rate cuts. Meanwhile, the current administration wants stability, but not if it means stalling economic momentum before the election. That puts Powell in the crosshairs. Too early, and he looks political. Too late, and he triggers collapse. So he's doing nothing, and hoping that nothing doesn't become everything. But Wall Street isn't buying it. Smart money is repositioning aggressively. Gold is trading above $3,396 an ounce. Bitcoin is trading at approximately $107,898. Institutional investors are loading up on short-term treasury bills, a classic flight to safety move. And beneath that, retail is breaking. Savings rates are collapsing. Real wages are stagnating. Debt is mounting. And millions of Americans are quietly sliding into financial quicksand while the Fed stands frozen. So what happens next? Here's the terrifying truth. The Fed is now gambling. They're betting that inflation won't return. They're betting that the labor market stays soft but not broken. They're betting that markets hold, that debt doesn't crack, that the public doesn't panic. And they're doing it all without any margin for error. One shock, just one, and it all unravels. That shock could be a major bank collapse, a geopolitical flashpoint, a wave of corporate defaults, or even a collapse in consumer demand that spirals into deflation. And when that happens, the Fed will be forced to act fast and hard. Emergency rate cuts, liquidity injections, coordinated bailouts. But by then, the damage will already be done and millions of people will be left scrambling. So what does this mean for you right now? It means you can't trust the surface anymore. You have to read the undercurrents. Because the people in charge are reacting, not leading. And that delay is a risk you can't afford. Here's what you need to watch. The labor market. If unemployment rises above 4.5%, brace yourself. Bond yields. If the inversion deepens, recession odds explode. Credit markets. If spreads widen fast, liquidity is drying up. Consumer sentiment. A sharp drop signals a collapse in demand. If more than two of these happen in tandem, the Fed will be forced into emergency mode. But again, by then, it's too late for most people. So what can you do? Start by cutting exposure to floating rate debt. Move excess capital into short-duration treasuries, high-yield savings, or defensive equities. Build cash reserves, not for panic, but for opportunity. Because when fear spikes, prices drop. And if you're liquid while others are desperate, you win. Second, strengthen your income streams. This isn't the time to rely on one paycheck. Diversify your skills, your offers, your revenue lines. The people who survive volatility don't always predict it. They just stay mobile and ready. Third, stop waiting for headlines. By the time the news tells you what's happening, it already happened. Markets move first. Then the Fed reacts. Then the media spins it. You need to operate in reverse. Watch the bond market, the credit market, the velocity of money. Those are your early signals. Finally, understand this. This Fed move, the refusal to move, is not a pause, it's a shift. It's the moment where hope runs out and strategy takes over. The illusion of control is gone. They're not guiding the economy, they're bracing for the impact. And now, so should you. This isn't doom, it's clarity. And clarity is a gift if you're willing to use it. Because what's coming next will separate those who listened from those who waited. We're not at the edge, we're already over it. The only question is how far the fall goes and who hits the ground first. Don't be one of them. You need to take control while the system still allows it, because when liquidity vanishes and credit seizes up, most people will have no options left. Banks will tighten, job markets will freeze, loan pools will dry up, and the people who waited for a press conference before acting, they'll be the ones calling hotlines, not calling plays. If this all sounds dramatic, it's because it is. The most dangerous thing the Fed can do in a fragile system is nothing. And that's exactly what they just did. By holding rates steady, they've effectively announced two things. One, they no longer believe they can act without consequences. Two, they're willing to let stress build if it keeps the illusion of stability alive. But pressure doesn't just vanish. It transfers, it builds, it breaks something else. Right now, that something else might be consumer debt, it might be commercial real estate, it might even be a major pension fund with over-leveraged bets on treasury spreads. And when it breaks, the Fed will say they're surprised. They'll say it wasn't in the data. They'll hold an emergency meeting and scramble to patch the hole. But you won't be surprised, because you're not watching the headlines. You're watching the system. You're tracking behavior, not words. And the behavior right now screams one message: brace, prepare, act. This is not a time for fear. It's a time for clarity, precision, and leadership. The system is flashing code red in slow motion. That's your window. That's your warning. And that's your edge. You don't need to predict every domino that falls. You just need to not be standing underneath them. If you're done waiting for permission and you're ready to lead through the chaos, subscribe to Wealth Signal now. Because what's coming isn't a cycle. It's a reset, and we're just getting started.